right now as the market is live. Roblox, ticker RBLX, is trading at $119.89. That is a stunning drop, down $13.85 on the day, a collapse of over 10.3%. This is happening on heavy volume, with nearly 10.5 million shares changing hands already this morning. The stock opened at $125.55 after closing yesterday at $133.74, and it has been a one-way slide, down to a low of $116.33. This is a complete liquidation. And here is the paradox, the absolute contradiction that defines today's market action. The company just reported what might be one of its best quarters ever. This morning, Roblox posted a 70% year-over-year surge in bookings to $1.92 billion, crushing estimates of $1.68 billion. They reported 151.5 million daily active users, another 70% jump, and completely blowing past estimates of 125 million. Revenue beat. Earnings per share beat. Hours engaged on the platform were up 91%. And to top it all off, they raised their full-year bookings guidance substantially. By every traditional metric, this stock should be exploding higher. Instead, it is imploding. This is the perfect example of the tension between market narrative and market reality. The expectation, the story that has propelled RBLX up 131% year-to-date was that Roblox is the dominant force in user-generated content, a virtual economy that is capturing the next generation. The narrative was that growth was accelerating. This morning's report confirmed that expectation in spectacular fashion. The company's performance was flawless. But the reality, the one that is causing this 10% haircut, is that the stock's price already reflected not just this perfection, but something far beyond it. This is a brutal, classic sell the news event. The stock was priced for an impossible-to-meet level of hype, and the moment the outstanding actual numbers hit the tape, the very same institutions that wrote it all the way up are now racing for the exits. What we are seeing is not a referendum on the business, it is a rapid, violent recalibration of its valuation. For the average person engaged in self-investing, this is one of the most confusing signals you can get. The news is good, the price is bad. This is where true analysis begins. Let's dig into the mechanics of this move because it's fascinating. The selling pressure isn't a slow drift, it's a high-volume capitulation. This isn't just a few traders on the Robinhood app getting spooked. This is the footprint of major funds. We know from 13F filings that firms like Fidelity Investments, BlackRock, and Capital Group were huge holders. In fact, Capital International Investors boosted its stake by over 680% back in the second quarter. Those institutions are sitting on massive gains from the $40 and $50 levels last year. To them, a blowout earnings report isn't a signal to buy more. It's the perfect liquidity event, the perfect cover to unload millions of shares at a premium price to an eager public. The algorithms at play, the ones running on sophisticated interactive brokers platforms, saw the guidance and the price and immediately calculated that the risk-reward had shifted. The big players are taking their profits, and the retail investor, the one just hearing the headline RBLX beats, is the one left holding the bag at the intraday low. It's a harsh lesson in market dynamics, one that we've seen time and time again with high-growth, narrative-driven names like Tesla stock or Nvidia stock. The story can be true, and the stock can still be a bad investment at a certain price. The numbers themselves are truly staggering, and they speak to the health of the actual business, which is what's being lost in today's panic. The 70% growth in daily active users is the key. This isn't just a pandemic-era fad, it's a sticky platform that is growing faster as it gets bigger. Critically, as Goldman Sachs noted, growth among older users, the 13 and over demographic, is surging 89% year over year. This is essential as it's the demographic with real spending power. This isn't just a kid's game, it's becoming a social platform. The 91% jump in hours engaged to 39.6 billion is almost hard to comprehend. And the bookings, the $1.92 billion, which is the most important metric. For those new to online investing, bookings represent the cash spent by users on Robux, the virtual currency. This is the real indicator of platform health, more so than revenue, which is recognized over a longer period. This number, beating estimates by nearly $250 million, signals that the user base isn't just growing, it's spending more. Add to that the 103% increase in free cash flow, and you have a business that is firing on all cylinders. This is the fundamental reality. So what does this company actually do to generate these numbers? It's crucial to understand that Roblox is not a game. It is a platform, an operating system for experiences. It provides millions of independent creators with the tools to build, publish, and monetize their own 3D worlds. Roblox's business model is to take a cut of the Robux spent within those experiences. It has created a massive developer economy, with creators earning over $1 billion in the last reported 12-month period. This is its moat. It doesn't have to guess what the next hit game will be. It simply provides the infrastructure for 10 million creators to guess it for it. The viral hits, like Steal a Brain Rot or 99 Nights in the Forest, mentioned by management, emerge organically from its own community. This is a far more scalable and defensible model than any traditional game studio. It's why so many Fidelity mutual funds and other large-scale asset managers bought into the long-term story. They aren't just betting on a single product, they're betting on an entire ecosystem, a new form of online investment in itself. This brings us to the future outlook, which is now the most important question for anyone with an individual brokerage account. The stock is broken, but is the story? The bull case is simple. You listen to the conference call, not the stock ticker. The company just raised its full-year bookings guidance to a range of $6.57 to $6.62 billion. This is a massive raise, far above what Wall Street was expecting. It implies that this 70% growth isn't a one-off. It implies that the new advertising business, which is just getting started, is all upside from here. The bull sees today's 10% drop as a gift, a chance to get into a hypergrowth compounder at a discount, an opportunity that many using a platform like SoFi Invest or Fidelity mobile app have been waiting for. They look at the 151 million daily active users and see a path to 1 billion. They see the growth in older demographics and the expansion into new markets like APAC and see a decades-long runway. But the bear case is what's winning the day. The bear looks at the price-to-book ratio of over 260 and says the valuation is indefensible regardless of the growth. The bear points to the persistent headline risks, like the subpoena from the Florida Attorney General or the platform being banned in Iraq over child safety concerns. These are significant, unquantifiable risks that could impair the brand. The bear also asks the most critical question: what do the 2026 comparisons look like? You cannot grow 70 to 90% forever. Management itself is signaling tougher comparisons ahead. The bear thesis is that all the good news and years of future good news was already in the $133 price. This sell-off isn't an opportunity, it's the beginning of a painful reversion to the mean. It's a signal that the easy gains are gone, and from here on out, the stock will be a grind. This is the dilemma for anyone looking for investment help, even from automated tools like Schwab Intelligent Portfolios. They can't parse this kind of narrative versus valuation conflict. This is the kind of day that tests an investor's conviction. As you watch the Fidelity trading platform light up with red, you have to ask yourself what you believe. Do you believe the numbers from the company or the price action from the market? Comment below with what you think is driving this sell-off. Is it valuation, or is it just smart money profit-taking from the big funds? Ultimately, the story of Roblox today is a perfect lesson in the separation of a company and its stock. The company's reality is one of stellar, accelerating growth that beat all expectations. Its execution was nearly perfect. The stock's reality is that it was priced at a level that demanded more than perfection. The 10% crash we're watching live isn't a sign of business failure. It is the sound of a valuation bubble bursting, or at least rapidly deflating. The core story, the one built on 151 million daily users and a booming developer economy, is arguably stronger today